We're just talking about loan programs for self-employed borrowers, right?
Right.
I mean, obviously, there's the normal way to do it, right? Conventional FHA, VA, USDA jumbo, just using somebody's tax returns,
Right.
right? But if there's not enough income on the tax returns, then we can do, non-QM loans, and they have different loan programs. There's bank statement, P&L, 1099. There's asset utilization. There's DSCR, which we talked about, either a month or two ago. And then there's another one also called community mortgage, which really only focuses on credit score, LTV, and reserves, right?
Hmm. Okay.
So it's not for everybody.
Right.
And then I just try to say, hey, most self-employed borrowers make more money than they report on their tax returns, i.e., they write off as much as they can to reduce the amount of taxes they have to pay. We have to use their net income, not their gross income. So many self-employed borrowers can't qualify the normal way, i.e., using tax returns. So this is when we look to these other types of loan programs to qualify them where we're not using their tax returns,
Right.
right?
Right.
So the
Is this
most
being
common
recorded?
one,
Are you recording this
yes,
for so you can share it?
yes,
Okay. All right.
yeah, but you can ask whatever you want.
Well, some of the stuff is personal that I'll leave out of it then. So,
All right. So the most common one that we do is bank statement, right? Where we're calculating the borrower's, their qualifying income from the deposits on their bank statements, right? So we can either use 12 months bank statements or 24 months bank statements, either personal or business. The rate is because I think a common question is, well, why would I use 24 months if I could just use 12 months? I mean, the rate's slightly better if you're using 24 months, right? Because there's a little bit longer history.
okay.
And what they do is they'll add up all the business related deposits. They'll divide it by either 12 or 24, whichever program we're doing. They try to take out what they determine to be one-time event type of deposits like a tax refund, right? It's
Right.
not a recurring deposit.
Sure.
And then, I also point this out. They're looking for trends as well, right? So are the monthly deposit amounts increasing or decreasing? Which,
Mhm.
might be another reason why you'd pick 12 or 24 months. Okay.
Okay. Right.
When you're using the personal bank statements, we can normally use 100% of the deposits. When we're using business bank statements, you can use as much as 85% of the deposits. So what they normally do when you're using business bank statements is they'll assume a 50% expense factor. So if the average of your deposits over 12 months is $10,000, they're going to cut that in half and they're going to give you 5,000 of qualifying income, assuming you have a 50% expense ratio. But
Okay.
most people don't have anywhere near a 50% expense ratio,
Right.
right? That are self-employed. So they'll they'll use a much lower expense ratio. You just have to get a letter from your CPA that says, you know, uh, the borrower's typical expense ratio, averages 20-25%. So the only thing that you need to use a lower expense ratio is just the CPA letter. Okay.
Okay.
So most investors will go down to a 20% expense ratio.
Mm.
So now you're using 80% of the deposits, not 50%.
Okay.
And we have a few investors, that'll go down to a 15% expense ratio. So again, he just has to be supported by a CPA letter.
Right.
They'll go up to 55% debt to income ratio. On bank statements, you could do as little as 10% down, right? But that assumes a higher credit score.
What's that mean?
Probably
700 plus?
720.
Okay.
I mean, if somebody's a 660 or a 680, they might have to put 15 or 20% down, right? So the down payment is really credit score driven
Okay.
on those. On really on all these non-QM type of loans, reserves are always required, normally 6 months, and sometimes it could be more, right? If the credit score is lower. As a side note, you can actually do a bank statement loan only being self-employed for 1 year. Now, the catch is you still have to show that you've been in that same line of work for 2 years. So
Right.
maybe you were W-2 and then you got switched over to 1099, right? So you only have 12 months of self-employed bank statements.
History. Right.
Yeah. But you can do it. But with all non-QM loans, they really want you still to be self-employed for 2 years. Gift funds are allowed. I mentioned you can use like asset utilization if you have to create some more income. And I have a slide on that. But let's just say that somebody they have 500,000 in mutual funds,
Right.
right? So we're able to then divide that by 60 months and then give them that additional income. That's referred to as the asset utilization piece.
Okay.
And you
So
can do
can I
these
back
for,
up? I'll
yeah,
back up a little bit.
yeah.
So one question I had, and you and I've spoke on this briefly, but it's about converting a 1099 to a W-2 with a, let's just say it's a LLC. So the borrower owns the LLC. Can the borrower convert themselves to a W-2 employee, and does that qualify, or does it still go back to a, tax return?
It still goes back to tax return because, once you own more than 25%, right, of an entity, the
Right.
LLC or the business, if you own at least 25%, then it's considered self-employed. So now you're using tax returns or you're going back to using 12 or 24 months bank statements.
Okay. All
Yeah.
right. So there's no way to get around it by W-2ing yourself. Doesn't really.
No, not
Yeah.
if you own at least 25% of the business.
Okay.
That'd be too easy.
All right. Hi, Andy.
Is he on here?
He
How's it
is.
going?
Oh,
We
why
have
can't
a personal one-on-one training today, I see.
Yes, and I mean, he paid a lot for it, but
The holidays are apparent.
yeah,
Yeah. And I'm telling him, like, go through this quick. So,
yeah,
Well,
yeah,
thanks for being on, Doug.
yeah.
good to see you. So,
Good to see you too.
And again, you can do these for primary residence, second homes, and investment properties. And again, is another note, you can do $3 and $4 million loans like this. It's just that when you go over about 1.5 million, they're going to require more money down.
okay.
You're not going to be able to do 10% down at 3 million, right?
So once you get to it, there's no conventional FHA loan limits. It's essentially, kind of what the investor wants to do.
Correct.
Really.
Correct. So that's bank statements. P&L, I think is becoming, more popular just because there's less documentation. It functions the same way, right? They're normally gonna require a 12-month P&L. We have some investors that will do less, but what's normal is a 12-month P&L. Again, they still require proof of 2 years in the same line of work. And they want the P&L doesn't have to be, audited per se, but they want it to be prepared by either a CPA, an EA, somebody who's a licensed tax prepare person, right?
Right. Right.
And then everything's the same. They default to the 50% expense factor, but you can use a much lower expense factor with a CPA letter. Um, they're using again, it's the net income on the P&L, not the gross income. But they're going to ask for either 2 or 3 months bank statements to look at those deposits to see if they match up with the gross revenue on the P&L, right? They want to tie the two together. And then everything else honestly is the same. You can go up to 55 DTI, you can put as little as 10% down. Everything else is the same.
Okay.
Pricing's the same. So some people would rather just do the P&L instead of providing 12 or 24 months bank statements, right?
Right.
You can also just do just you know, a 1 year 1099 only, right? Somebody just provides the 1099, right? Same
Okay.
thing. Yeah, we're using that gross figure, 50% expense factor. Everything else is the same.
Okay.
Right. So you can go bank statements, you can go P&L, or you can do 1099 only. They all function exactly the same way.
Okay.
Then just quickly on asset utilization, if somebody needs some additional income, right? They just don't quite have
Right.
enough,
Right.
So like we talked about, it just has to be a liquid account, could be checking, savings, stocks, bonds, mutual funds, money market, vested retirement, and they divide it by 60 months, you know.
Oh, okay.
Yeah,
Okay.
and then they just give you that additional income. You can
Okay.
even use crypto as long as it's converted to US dollars. If you're just doing asset utilization, they normally require 20% down, but I think you could still go 10% down doing like a bank statement and then adding asset utilization.
Okay.
Um, you know, Again, like you can combine it with W-2, 1099 pension, Social Security, all that stuff. All the stuff, everything else is the same. We talked about, which we've done before, debt service coverage ratio loans for investors.
So, and when we talk about that, because we've
Yeah.
kind of talked about, we've even talked about buying a cabin or something up north
Mhm.
and in doing maybe an Airbnb scenario with it, some to, be able to utilize it ourselves, but offset a lot of it with that. So that'd be kind of a combination DSCR then, or just do a straight DSCR self-employed, or what's that combo look like?
I mean, I think it's the same. It's just a normal debt service coverage ratio as an
Okay.
investor. Yeah.
Okay. All right.
And it's just, does the rent cover the mortgage payment basically, right? 20% down.
Okay. All
Yeah.
right.
And then we have one investor that offers, they call it their community mortgage. And this, I mean, I feel like it sounds better than it is, but it's a fairly simple loan program where they're only looking at three things. They are looking at credit score, down payment, or LTV and reserves. But, once you get into the details, they require a higher credit score, 720.
Mm.
They normally require like 35% down. And then they're going to want like 18 months of reserves.
Yeah. And the rate's the killer.
Yeah. It's just, somebody that just doesn't, they don't have any income, but they have a bunch of assets.
Right.
And
Okay.
I feel like that person, might be able to figure out a different way to get a mortgage done where the rate's less than eights or nines.
You would think, but
You would
okay.
think,
Yeah.
if they have that much money, you would think.
Mm.
But it's an option nonetheless. And then I always just say, with all non-QM type of loans, just FYI, rates are higher, closing costs are more. So it's more helpful, right? If you
Right.
can get seller concessions to cover the additional closing cost. I mean,
Right.
they're basically double the closing cost, right? And do you know why that is?
Risk.
No, it actually has to do with our comp, right? So
Mm.
on normal mortgage loans, conventional FHAB, all that stuff, you know, our compensation's built into the rate, right? So
Right.
nine times out of 10, that's how all loan officers are
They close.
compensated, right?
Right.
It's built into the rate. But and you can do the same thing with non-QM loans. It's just that non-QM rates are higher. And then if you want to build your compensation into the rate's even higher,
Sure.
right?
Right.
So you normally don't do that.
Right.
So what you do is it's called borrower paid compensation as opposed to lender paid compensation. And it just means the borrower is paying our compensation.
Okay.
So you're really just charging points,
Right. Right.
and I don't know how Andy does it, but the way I do it, I just charge less, you know? I mean, if we normally get paid two and a quarter, maybe we'll charge 1.5 or 1.75. Like it feels like it's not too bad.
Depends on
Right.
the loan amount.
Yeah, yeah.
Okay.
We just know we're going to take a little bit of a haircut on these types of loans, but it's fine.
Right.
Yeah. So, I think there are several different ways to get self-employed people qualified for a mortgage to buy a house if they can't qualify using their tax returns.
Yeah.
Yeah.
So I went to a meeting last night on ADUs. The
Hmm.
town of Queen Creek had a meeting about, all the buzz about ADU and, the blah, blah, blah. You're seeing much of that come into play with can you use ADU income
They
on,
have changed some rules on that. So I think it's mainly Freddie Mac. This stuff wouldn't really apply to it. These are different guidelines, but I want to say I pulled it up a while back. I can't remember the specifics, but basically, if you have an ADU, it looks like you can use some of that rent, of the ADU now for like
To
if they already
to
have the
improve your ratios,
ADU
I
or
guess,
on
a
a
little bit then.
purchase.
So, okay.
Yeah.
And
I don't
Andy,
remember the
Andy, you
specifics.
think it'll be the same where you can use 75%
I
of
believe
the,
it's something a lot, or I think they might just throw it in as additional income and not even on the property. It's goofy. Like if you go into the LOS, like in our origination software, there's a place under where you put employment, you can
yep.
add ADU income.
Yeah.
Oh, okay. So, yeah, I was just curious whether that's even coming into play much. So,
Oh yeah, if you have one like that, we'd have to vet it out just to make sure it's
right.
wise. But yeah,
I mean, it's
Okay.
been talked about a lot, but I haven't seen very many buyers making offers on properties that have ADUs with income. I haven't seen that yet.
Yeah.
I'm sure it's
no,
coming.
but
I'm sure it's coming.
it'll come up more.
Yeah.
I mean, again, there's not every property has it first and foremost, right? So you have to find the properties that do. But yeah, I mean, it'll be a thing. It'll be something that'll help.
Well, it's interesting that they're trying to push it. I mean, it really came down from the state legislature. I mean, they're the ones who created it and allowed in Phoenix, you can do up to 2
Yep.
ADUs on your property, and all these different factors are kind of trying to, some of it's around affordable housing related topics they're trying to address anyway. I don't, not sure how successful they're going to be with this. I mean,
Yeah.
other than you're going to have a few people in Phoenix going to convert their garages and call it an ADU, and I mean, there's going to be some of that probably, but I mean, I don't think there'll be a lot of traffic in this area.
I don't think, I mean, yeah, I think it'd be more expensive than people realize to build an ADU structure in most cases.
100%.
Then they're going to realize, well, it doesn't really pencil out. I mean, it
Right.
definitely changes the look of properties. I think you have, just car parking issues and,
Exactly.
yeah,
But yeah, you're right. Lots of factors.
yeah, yeah. So,
Okay.
any other questions on self-employed borrower loans?
No, you covered it. Thank you.
All right, well, you
Appreciate
got
it.
it. Just be aware that there's those loan programs out there.
Okay, Dave, thank you again. Good night.
You're welcome, Doug.
Appreciate it. If we don't happen to talk, have a great holiday yourself. So too.
I will. Thank you so much.
All right.
Happy
Take care.
holidays.
Thank you.
Thanks for
Bye.
joining us.
Yeah. Bye-bye.
Take care.